If they have 50 million in inventory they paid for and they're trying to break it down and turn it into shot and then melt it down and turn it into bars and rounds, that takes a period of time. You got to hedge that inventory. Well, they were getting margin called all through January as the price kept going higher and higher and higher. They had shorted the same amount that they had in inventory. In the month of February, who stood for delivery for 2 million pounds and left, right? 2 million pounds plus left Comex. Who the hell did that? But that's every month. Now, I'm not saying every month we're seeing that kind of volume leaving on the loadouts. We're seeing a lot. Some of it stays in. Well, 2-3 weeks ago Friday, staying in the eligible category, which are not the bars backing the contracts registered, 2 million ounces of silver, goodbye, just left Comex. Where did it go? Is that Samsung? And then you see China say, well, we're not going to export sulfuric acid anymore, which you need for copper mining.
And then this is, if we break through here, we go to 92. But again, high, lower high, lower high, low, lower low. Eventually, this tells us we're going down. And really, you have a very clear bearish pattern here, right? This is the classic bearish consolidation leading down to this level. For me as a buyer, I'm waiting for about the 49 to 54 level to be a buyer. It would basically be a retrace to this. Based on this, what does this tell us? Well, it tells us that, whether or not we go up to this level or not, eventually gold's coming down here to 3,900. Now, 3,900 makes a lot of sense. Why? Because that's also this pivot low.
Something significant is happening beneath the surface of the silver market. Dealers carrying physical inventory, already hedged short against their holdings, were hammered with margin calls throughout January as silver prices pushed relentlessly higher. Then, in February alone, over 2 million pounds of physical silver stood for delivery and walked straight out of Comex. Weeks later, another 2 million ounces quietly exited the eligible category, inventory that was never backing registered contracts to begin with. Add China restricting sulfuric acid exports needed for copper mining, and the supply picture for industrial metals tightens further. Physical metal is moving, and it is moving fast. 2 million ounces of silver, goodbye, just left Comex. Where did it go? On the technical side, gold's chart is painting a classic bearish consolidation pattern, a sequence of higher highs followed by lower lows that historically precedes a pullback. The key support zone to watch sits between $3,900 and a pivot low that has held structural significance across multiple timeframes. For silver, patient buyers are eyeing the $49 to $54 range as a potential re-entry window should the current pattern resolve to the downside. The data and the charts together are telling a coherent story: short-term pressure, long-term physical scarcity. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The market and the deliveries and the central bank buying, in my mind, tells a very, very, very different story. And, I think that when you take a look, like, for example, let's look at China. China has cut its treasury holdings in half, going from 1.3 trillion, roughly, not too long ago, down to 650 billion. That's the lowest level they've had in almost 20 years. And based on their accelerating gold purchases, now 17 straight months, it would seem to me they are reallocating this money into gold. And this follows a trend we've seen for several years with central banks buying gold, over 1,000 tons again last year. And again, the counterparty trust element, countries like Germany and France, who just made another big deal about bringing their gold back from the New York Fed, in India from the Bank of England, repatriating their gold. Others are doing the same thing. The message is simple. Nations that once trusted the dollar are moving into gold and silver that they can actually hold. That's why this old argument of rising interest rates are bad for gold is in the month of February, and they're the second largest producer in the world, right? Why are we seeing deliveries on Comex at a level that no one's ever seen before, month over month over month over month over month? And again, let's look at February as an example. February, when the price of gold and silver were getting their teeth kicked in, is a non-delivery month. Typically, it's like January is, February is not, March is, April right now is not, May is. But you can still take delivery. In February, in terms of silver, there was about 25.5 million ounces delivered, which, again, My whole career, Daryl, no one ever stood for delivery. Less than 1% of contracts stood for delivery. It was the anomaly. Now we're seeing massive deliveries. The majority of the contracts that were posted stood for delivery in February. 25 million ounces. That's a lot. That was one of the smaller delivery months in the past 18, but at $70, you're 1.5 trillion? Billion, excuse me, $1.5 billion. But of the 25 million plus ounces that stood for delivery, 39 million ounces or thereabouts left Comex. Left. That's 2 million pounds of silver got on trucks and went by, left the building. Now, that's 160% of what deliveries could explain alone. Who in God's green earth is standing for delivery and taking possession? 39 million times, call it $70 even at that point, which was higher than that, but let's just use 70. 39 million times 70, $2.73 billion worth of silver just said bye-bye and left Comex. So who did that? Who arranged the trucks and the logistics and the insurance, and where the hell did it go? So what I'm saying is, when you see central banks, China for 17 straight months, right? All of these central banks, Poland and on and on and on and on, Brazil, none of this stuff is by chance, but the last thing they want is for speculation and the word to get out, crowding them out of their trade. But then just ask yourself, in the month of February, who stood for delivery for 2 million pounds and left, right? 2 million pounds plus left Comex. Who the hell did that? But that's every month. Now, I'm not saying every month we're seeing that kind of volume leaving on the loadouts. We're seeing a lot. Mm-hmm. Some of it stays in. Well, 2-3 weeks ago Friday, staying in the eligible category, which are not the bars backing the contracts registered, 2 million ounces of silver, goodbye, just left Comex. Where did it go? Is that Samsung? And then you see China say, well, we're not going to export sulfuric acid anymore, which you need for copper mining. Silver is a massive byproduct of copper mining. In fact, the majority of silver mined comes from byproduct mining of copper, lead, and zinc. Yep. Well, if all of a sudden the copper is going to get crushed, well, what does that mean for silver? Do you think companies like Tesla are going to wait around to find out? Or are they going to say, give me that 2 million ounces of silver, I need to take possession of it right now? I'm not leaving it in the ecosystem to find out. What I'm trying to say is the conventional argument is dead wrong. And this is why there's an entire school of theory for investing called wave theory, Kondraty and Elliott wave. So you can see the cost is very high to hedge that. You got to have $20 million sitting in your margin account, right? Okay, fine, that's just silver. What about gold and platinum? By the beginning of January, that number had gone up 300% in terms of what you needed to have in your account. So 15,000 became over 50,000. To hedge 5,000 ounces. The cost of hedging your position became so high, the cost just became, it had to filter down into lower bid prices. And if you weren't hedging, a lot of the companies don't hedge, and the price fell by 30% when you're lucky to make 2% in this industry, you're done, you're crushed. So if you don't hedge, you better back your bid prices way back. Because if not, and it goes against you, you are out of business. If you do hedge, your cost went up so much that the cost of doing business is such that you won't make any money unless you start to change things.
Here's gold, and I have the key levels that I've talked about now for months on the screen. We know, again, we have our major support here at 44 to 4,300. Notice how after the top was put in, we flushed straight down, we kissed 4,400, and we got our big bounce. Then we went up to the body. Notice the body right here. That's telling us that's resistance right there. It wasn't able to get back to its all-time high. That also shows us a little weakness, right? It was telling us that it had trouble getting up there, so it was most likely going to fall again. Where did it come? It came down. It made a lower low, but it also, that was only the wick, right? Or the tail here. And the bodies stopped right here at 43 to 4,400. So it basically gives us a range that gold's been trading in the near term. Now, just a little side note here, understanding support levels. So if you look at the chart on gold, we had the first big run from August 2025 up into this high pivot in October, right? And at that point, that's where gold started to stall. It came back in, it came up, it came back down, came up, sideways, and then it finally broke out. And then look at how when it came back in, this now became support. Now, one of the key tenets of technical analysis is that when you break out of resistance, You then oftentimes come back, but the former resistance now becomes support. So support becomes resistance, resistance becomes support in this case. These are the lines I've had on my silver chart, $82. We actually just hit that on Friday. That was the key resistance. And again, if you follow my game plans Monday through Friday, which is a live show on YouTube on the Verified Investing YouTube, then obviously you know about the 82 level and so on and so forth. And then this is, if we break through here, we go to 92. But again, high, lower high, lower high, low, lower low. Eventually, this tells us we're going down. And really, you have a very clear bearish pattern here, right? This is the classic bearish consolidation leading down to this level. For me as a buyer, I'm waiting for about the 49 to 54 level to be a buyer. It would basically be a retrace to this. And by the way, what's interesting on this is gold has already, notice this, guys, and this is really interesting.
China has slashed its U.S. Treasury holdings from roughly $1.3 trillion to just $650 billion, the lowest level in nearly 2 decades, while simultaneously buying gold for 17 consecutive months. Germany, France, India, Poland, Brazil, and others are repatriating their physical gold from foreign vaults. The message from sovereign wealth managers is unmistakable. Nations that once anchored their reserves in dollar-based assets are rotating into gold and silver they can physically hold. This is not coincidence. It is a coordinated, deliberate shift in global reserve strategy. $2.73 billion worth of silver left Comex in a single month. Someone arranged the trucks, the logistics, the insurance, and no one is talking about it. Meanwhile, February, historically a non-delivery month, saw 25.5 million ounces of silver delivered on Comex, with 39 million ounces physically departing the exchange altogether. That is 160% of what deliveries alone could account for. With China restricting sulfuric acid exports critical to copper mining, and silver being predominantly a byproduct of copper, lead, and zinc extraction, the industrial supply squeeze is tightening. Hedging costs for dealers have tripled, crushing margins industry-wide. The conventional wisdom that rising rates suppress gold is being dismantled in real time, one truckload of silver at a time. Let's get back to the interview.
And then this is, if we break through here, we go to 92. But again, high, lower high, lower high, low, lower low. Eventually, this tells us we're going down. And really, you have a very clear bearish pattern here, right? This is the classic bearish consolidation leading down to this level. For me as a buyer, I'm waiting for about the 49 to 54 level to be a buyer. It would basically be a retrace to this. And by the way, what's interesting on this is gold has...
I mean, in 71, when Nixon closed the gold window, it was largely because of de Gaulle from France, who realized that the guns and butter platform that we had, that we were printing more dollars than we had in gold at Fort Knox. They understood this to fund largely the Vietnam War. So he sent warships over filled with dollar bills to New York Harbor, said we want our gold, and we gave it to him largely. Bled down over a period of time over half of the gold that the Treasury held, and that's why he temporarily closed the gold window. Hasn't opened back up yet, by the way, but that's why he did it, because they were all calling our bluff, and that's when the good as gold guarantee ended. From the end of World War II until 1971, we told sovereign governments that you can at any time, we'll take your gold, we'll pay you $35 an ounce for it. Take that money, invest it in treasuries. You'll earn a yield on your non-yielding asset. We'll hold it for you. You guys have been in the midst of 2 world wars. Safe over here. We'll hold it. You can always get it back at $35 an ounce. In the meantime, you don't have to store it, and you can make a return. You benefit our economy. We help you. Everyone wins. And so they could exchange their gold for $35 an ounce, and then Nixon said, "No, game over. We're going to keep the gold. Sorry." Which ended the backing of gold for the dollar. It was 2 years later that Kissinger went to Saudi Arabia and struck a deal with the Saudis for the petrodollar, which seems to be waning right now. But as far as France, look, for 50 years subsequently, countries would hold their gold at the New York Federal Reserve and at the Bank of England. And the reason they did it was less for diversity and more for access to the markets. The Comex market is the global price-setting market for gold and silver, so they would leave it at the New York Federal Reserve, safe jurisdiction, Western rule of law, wink, wink, and they could have direct access to the Comex. Same thing with the Bank of England and the LBMA. When you saw Germany in 2017 make a massive stink about getting their gold back, which they'd been trying to do for 3 years, and finally took out, articles and editorial articles in the Wall Street Journal, give us our damn gold back. But that should have got more attention, because right after that, the Dutch National Bank, the Bank of Turkey, Hungary, Poland, the Czech National Bank, they all did the same thing, give us back our gold. And now you're seeing France, you're seeing India repatriate all their gold from the Bank of England. France just got their gold back. Germany wants the rest of their gold back. It's a lack of trust. This all boils down to trust. No one trusts the treasury market anymore. It's been weaponized against Russia. We defaulted and stole their treasuries that we were holding, and worse yet, largely gave the proceeds to the country they were in the midst of a war against. When you are the world reserve currency, a country that invaded Iraq 22 years ago, and still went there under false pretenses. We never found those weapons. And that's in essence what they're doing. Holding your money in 10-year treasuries is absurdly foolish, because not only is the inflation numbers manipulated, or are the inflation numbers manipulated, so too are the treasury yields by things just like this, where no one wants to buy it, so the Fed comes in and quietly buys it. They've been doing it all along, just haven't been telling us, unless you believe the Cayman Islands is actually number 2 or 3 in treasury purchases. Really? Or is that a shell corporation, quietly on behalf of the Fed buying our treasuries? So, yeah, I think organic demand for U.S. treasuries that can be confiscated, that are fiscally irresponsible, the currency behind it, and a treasury market that has been doubled in performance by gold over the last 25 years. Look at the last few years. It's way higher. 2 years ago, gold was up 40%, the 10-year treasury up 4.5%. Last year, gold was up 70, 80%, 10-year treasury up 4%. Look at it this year. Any way you look at it, holding your wealth in treasuries and in dollars has the lasting value proposition of a melting ice cube, Daryl, and I think the world finally gets it. So a system based on trust that is no longer trusted, that's a problem. And that's kind of, I think, what you see happening. Question is it by design? Is it a way, are we doing this purposely, pissing everybody off? I mean, that's a stretch, but are we doing it so that you see massive dollar dumping, dollar debasement to pay off the debt, to bring back manufacturing? Could it be? Maybe. Before I get there, that narrative, again, is just stupid. I mean, and that's what they want us to believe, right? And that rates are going higher, so that's bad for gold. Well, how about the fact that for 2-3 years after COVID, rates went higher faster than any time in history, from like 0 to 4+ in a period of like a year, and gold still went to the moon and tripled since then. Here we are since it was 0 in 2021 or whatever, to where we are now, from like 1,700 to almost 5,000 in rising rates. Convenient to ignore that by the mainstream when it's happening. And yeah, they want us to believe that, but if that were the truth, then why are we seeing record deliveries every single month? Why in the month of February did China import more silver than in the history of all recorded markets going into China ever? The month that it got destroyed. Why are we seeing these deliveries in every single month on Comex? So far in April, 18,647 gold contracts at 100 ounces apiece. That's almost $1 billion. And 1,753 silver contracts at 5,000 ounces apiece. So let's do the math there. 1,753 times 5,000 is 8,765,000 ounces. And let's multiply that times... oh gosh, silver's up almost $4 right now. It's at 79.20. So let's multiply that times 79. That's $692 million worth of silver have been delivered so far in the first week or so.
Oh, $1 billion?
Yeah.
$1 million. Yeah.
692,435,000.
Okay.
But by the end of the month, because that's only for the first, what's the date today? It's for the first 2 weeks. By the end of the month, we'll be way over $1 billion. And it's been way over $1 billion every single month. In February, which is a non-delivery month, 25 million ounces delivered, 39 million ounces leave Comex. 160% of what was delivered left. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? 2 million ounces leave the eligible category a few Fridays ago. Those aren't even the bars that are available for sale, because no one trusts the system anymore.
When Nixon closed the gold window in 1971, it was not an act of economic strength, it was a forced concession. Foreign nations, led by France, had called America's bluff, demanding gold in exchange for the dollars flooding global markets to finance the Vietnam War. That moment ended the Bretton Woods guarantee and launched the petrodollar era, a system now visibly fraying at its edges. For decades since, sovereign nations stored their gold at the New York Federal Reserve and the Bank of England, not for safekeeping alone, but for proximity to Comex and the LBMA price-setting markets. That arrangement depended entirely on trust. Holding your wealth in treasuries and in dollars has the lasting value proposition of a melting ice cube, and the world finally gets it. That trust is now broken. The weaponization of the dollar against Russia, freezing and effectively seizing sovereign reserves, sent an unmistakable signal to every nation watching. Germany, the Netherlands, Turkey, Hungary, Poland, the Czech Republic, France, and India have all moved to repatriate their physical gold. Over the past 25 years, gold has more than doubled the performance of 10-year treasuries. In 2023, gold rose roughly 40% against treasuries returning 4.5%. In 2024, it climbed close to 70 to 80% against a similar treasury yield. April 2026 alone has already seen nearly $700 million in silver delivered on Comex in the first 2 weeks, on pace to exceed $1 billion by month end, as it has every month running. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.